It's John Observation here, and today we are witnessing something extraordinary unfolding in real time. Something that most people will completely miss if they're only watching price charts and headlines. A low-profile Chinese billionaire, a trader who quietly made nearly $3 billion by being bullish on gold, has just placed one of the largest silver short positions in history. Roughly $300 million wagered against silver through the Shanghai Futures Exchange. That position represents about 30,000 contracts, nearly 450 tons of silver. And yes, the recent sharp drop in silver prices has already boosted his paper gains. But here's the key point. While this massive short position is being built on paper, something far bigger and far more important is happening beneath the surface, and it has nothing to do with technical indicators or short-term price action. At the exact same time this Chinese billionaire is betting against silver, the Trump administration has convened an unprecedented ministerial meeting involving 54 countries to address critical mineral supply chains, pricing mechanisms, and strategic independence. This meeting was hosted by J.D. Vance and Marco Rubio, and it represents roughly 2/3 of global GDP sitting in one room. When officials use the phrase critical minerals, understand this clearly. It is code. Code for physical commodities that are essential to industrial economies, military readiness, energy infrastructure, and monetary stability. And silver sits right at the center of that conversation. President Trump is not going to allow China or anyone else to corner the global silver market. That much is becoming unmistakably clear. The global silver market is already in a structural supply deficit. There is simply not enough physical silver to meet rising industrial, monetary, and investment demand at current prices. That imbalance can only be resolved in three ways: significantly higher prices, materially increased production, or reduced demand through strategic exclusion, specifically by cutting off Chinese access to Western metals. And what we are seeing now is the US government firing all three of those silver weapons simultaneously. Policy support, supply chain restructuring, and price stabilization mechanisms are being rolled out in tandem. This is not accidental, it is deliberate. As of this recording, the price discrepancies tell their own story. Western spot silver is hovering around 70, Shanghai spot is closer to 81, Shanghai futures are near 99, and the Shanghai premium alone is around $11. Gold sits near 4,808. These spreads are not normal. They are screaming stress in the physical market. And before we go further, let me address something many of you asked about: the 87 to 90 resistance zone in the paper silver market. We flagged it clearly, and we saw 3 separate rejections in that range. Price has since pulled back to around 71. If you want deeper technical breakdowns occasionally, let me know in the comments. We can do that when it truly matters. But for long-term investors and physical stackers, understand this clearly. This is noise, pure noise. For paper traders, however, this environment is lethal if you're undisciplined. I've said it repeatedly. If you're over-leveraged, trading too large, and operating without a defined plan, these markets will destroy you. Volatility is extreme. Everything is dumping at once: stocks, crypto, metals, across the board. Risk management is not optional here, it's survival. If you're here to actually learn and understand what's happening beneath the surface, hit subscribe, drop a comment, and let me know whether you want occasional deep dives into technicals when the situation demands it. Now let's go back to that ministerial meeting. J.D. Vance made something very clear. Despite all the noise around digital economies and technology, real physical commodities remain foundational. You cannot build an economy, a military, or a supply chain on software alone. He emphasized that international critical minerals markets are failing to create sustainable domestic industries or secure supply chains. Pricing mechanisms are broken, supply chains are overly concentrated, commodity prices have been persistently suppressed by forces outside the control of individual nations. Mining projects stall, investments dry up, and production becomes impossible under erratic and manipulated pricing. The stated goal of this initiative is to stabilize prices so domestic supply chains can be built and maintained. Read between the lines. This is official acknowledgement, at the highest levels, that price suppression exists and that intervention is coming. And while politicians talk, the physical market is already breaking. An Australian bullion dealer, City Gold, has halted silver sales entirely due to a global shortage. Not a demand spike, a shortage. Dealers do not stop selling unless supply is gone. In India, the MCX raised silver margins by 7% and gold margins by just 3%. Exchanges do not raise margins because they feel comfortable. They do it because they are afraid. High margins signal stress. Stress signals positioning risk. And positioning risk means too many traders are on the wrong side of the trade. This isn't about protecting investors. It's about protecting the system itself. Look at the COMEX. Silver delivery notices continue to pile up. Over 600 delivery notices issued in a single day. JP Morgan alone issued more than 500 and stopped nearly 240. Total February, silver deliveries surged past 3,500 contracts, nearly 18 million ounces, just 4 days into a non-primary delivery month. Gold deliveries are also strong, but silver is the standout. Physical demand is relentless. Then there's backwardation. After a historic paper price slam, silver is trading nearly 80 cents per ounce above the front-month futures contract. That is backwardation. You are paying more for silver today than you would for delivery months from now. That only happens when physical supply is desperately tight and no one wants to wait. This is one of the clearest signals of physical stress you will ever see. Zoom out further. The macro environment is collapsing everywhere at once. The crypto market peaked at $4.3 trillion just months ago. It's now closer to $2.3 trillion. $2 trillion erased. Nearly half of crypto's total value wiped out. Bitcoin has fallen below its previous all-time high. US stocks are rolling over on weak labor data. Jobless claims are rising. Layoffs are accelerating. January job cuts hit levels not seen since 2009. Hiring plans are drying up. When layoffs rise while hiring slows, that is a classic leading indicator of economic downturn. The US dollar is dumping at one of the fastest rates since 1980. Once the strongest G10 currency, it is now among the weakest. Political uncertainty, aggressive and unpredictable trade policy, tariffs, concerns over Fed independence, ballooning deficits, capital is flowing out. Investors are reducing US exposure and moving toward hard assets. Treasury Secretary Bessent has even acknowledged reports of China developing digital assets backed by physical commodities. China has been dumping US treasuries for years while doubling its gold reserves. This is not theory, it is documented reality. And here's the most important point of all. When every asset on Earth crashes at the same time, that is not a free market. That only happens under extreme manipulation and forced deleveraging. Precious metals sit at the center of this storm. Banks remain heavily short silver on paper, while physical demand continues to overwhelm supply. The disconnect between paper pricing and physical reality has never been wider. The timing matters. The coordinated smash in derivatives occurred right before the 54-country critical minerals meeting. That was not coincidence. This meeting wasn't symbolic. It was preparatory. A coordinated global reset of critical minerals pricing, supply chains, and production is underway. While a Chinese billionaire places a $300 million paper short, the US and its allies are restructuring the physical market itself. So here's the real tension. In the short term, sentiment became too bullish. Leverage piled in. Corrections happen, even in structurally tight markets. We've seen it repeatedly since the 2022 lows. Oversold conditions can persist during deleveraging, but the fundamentals have not changed. Physical shortages are intensifying. Dealers are halting sales. Backwardation is screaming stress. Policy is shifting toward price floors and supply chain independence. The question now is simple but profound. Does the Chinese billionaire's massive paper short get squeezed as price floors are implemented and physical shortages worsen? Or does deleveraging push prices lower before structural forces take full control? Timeline matters. But one thing is certain: manipulation is being openly acknowledged, and policy is moving to end it. Know your time frame. Do your own due diligence. Understand the risks. Invest with logic, not hype. Use your own brain, and don't follow anyone blindly.